And welcome to the VSA Capital Tech and Transitional Energy podcast. It's October the 14th, and yet another busy week, hasn't it been, Phil?
Yeah, it has. Plenty of news. Yeah, there's a lot going on.
Plenty of news, quite a lot of sort of macro stuff as well. We always know October is traditionally quite a difficult month, and you tend to have storms and market crashes and things. The crash of '87, which I remember very well. Not everybody listening to this probably does, but that was obviously an October crash. It seems like a little blip if you look at the charts now, but it was at the time. It was horrific. But October is often a difficult month, and this month we've seen obviously huge concerns with the petrol strike and gas prices going through the roof. Inflation and macro issues. I mean, this morning we saw factory gate prices in China up 10.7% for the year. Well, that gives you a bit of a clue of actually what probably global inflation is running at. And my view is that inflation probably is running in double figures in reality. They'll never report that. And that obviously is quite nervy for stock markets. And because they worry that interest rates will have to go up to dampen it down. I think consumer demand will drop off and they'll come down naturally by the middle of next year. But what we have seen this week is IPOs being pulled. We saw a couple at the beginning of the week. One actually, Frugo, I think it was pulled, and that's obviously in the brand sector. We'll maybe talk about that later. But we saw Marley being pulled as well. And then actually today we had some quite weird announcements coming out with IPOs intentions to float, or we still expect to float, which was an interesting one. I've never seen that before. Okay, so they're sort of saying we may or may not float depending upon the market, I guess. Yeah. But that was a big float actually called Rubik's Group, which is being done by Goldman Sachs, Morgan Stanley, and Barclays. I just never seen that. It still expects to IPO. So yeah, the macro picture is quite tricky. The market has been pretty volatile. And then probably the stock that has been in the headlines and is very relevant to this call has been the Hut Group, isn't it?
Yeah, THG. They had call with analysts and investors earlier in the week. And these calls are normally to reassure on everything and to outline the strategy and the prospects ahead.
Well, I mean, he didn't do a terribly good job, did he? Because, the stock had been collapsing, as we discussed last week, because of what the FT was commenting upon. And it carried on collapsing during the investor call. It's, and I think it sort of reminded people about some of these big IPOs that, you get all the big well-known banks doing them, but are they actually the IPOs you want to follow?
Yeah, you're right, Andrew, that you need to look very closely at the business and the way it's structured and the way it's managed. And I think one of the challenges here for the market has been the management in terms of, a joint chief exec chairman, all these, his core holding, how much influence he has on the business. And it's that shift from being a private company to being a public company where you have a new set of owners, which are pension funds, and mainly pension funds, and they need to be treated accordingly. I mean, at the end of the day, this is part of people's pensions that are being invested.
I mean, look, this is a tech and transitional energy podcast, so I don't want to waffle off on too much of a big picture, but, you hear all about these city reforms that will allow for these strange structured companies and SPACs and all this sort of thing. I don't think that is the solution to the city's problems. Because here is proof of the pudding. You start having these sort of wacky structures and it actually doesn't really work. And, there's a great saying, I think it was Warren Buffett that said it, if you can't understand a company, don't buy it. And I think that probably is true to the Hut Group. Also, sometimes there's another good saying, which if it's too good to be true, it probably is too good to be true. Sticking to fundamentals. And one of the fund managers that I have a lot of time for and who I do invest in his mid-cap fund, actually, but in my view, he's probably one of the smartest fund managers out there, is Andy Buffett Schroeder's. And, it's interesting. I've been listening to some of the stuff he's been saying, and he would certainly go along with those policies. He's actually a big fan of IPOs, but he's also, cautious of IPOs that try not to be sensible for all involved. And what he always says is, look, everybody's got to go away with a party balloon. So, the investors should get in a good deal. The company should, have a deal that is appropriate, not trying to, maximize the price. People shouldn't all be selling out at the same time. There's ways of doing this, and THG really just didn't do it in the way that where everybody got a party balloon. It felt like only a few people, the sellers, got a party balloon. Andy, if you're listening to this, do correct me if you think I'm wrong with what you have to say. But I think that's the thing. Everyone's got to go away with a party balloon. Wouldn't you agree with that, Phil?
Oh, I do. Yes, and as a holder of funds in my SIP, I most certainly do. And as I say, at the end of the day, a lot of this money is people's pensions, and I think boards of directors who are managing those people's money should be, appropriately careful with it.
Having said all that together, I still think the brand sector has got plenty of growth within it. Certainly in particular areas. I mean, I think there was a lot of publicity this week about plant burgers being sold at McDonald's. I mean, just before you give your view, I have to say personally, if you're a vegetarian, why are you going to McDonald's? Why are you going for a burger? I mean, a burger is, maybe I'm old-fashioned and a dinosaur, but a burger is a burger and it's meat. If you want to eat vegetarian food, go to a salad bar. But I'll probably get criticised for saying that one, I feel.
Yeah, well, I'm going to balance that one. I would say, well, if all your mates, your friends are off for a burger, you'd like to go with them and have something to eat. So, Mackie D's are, catering for you. So, there. I could see the rationale on the other side, and it's widening their audience as well, and ultimately, it's concerning beef. So, as we know, that's a big creator of greenhouse gases and methane. So,
they do say it's the biggest. They say that beef cattle raising is the biggest creator of greenhouse gases, and that is the biggest issue for climate change. I think, as most people know, my view is actually the biggest issue is that we just have too much population in this world. Population has gone exponential. That's the wrong word. Exponential, whatever it is, extrapolated by miles in the last couple of hundred years. I mean, there are just too many people living on this planet. And of course, they all want to eat better and better food, which means, they're all aiming to go and try and have a really nice steak, which, by the way, I had last night. It was absolutely delicious. Adding to the greenhouse cushion. Well, we're rambling a bit off piste here, actually. We need to get back onto tech and trans, don't we?
Yeah,
but I'll tell you what, look, obviously, there's a lot of information out on the Hut group. We don't really need to discuss it anymore. But whilst we're on transitional energy, I am pleased that our favourite that we do tend to talk about almost every week in Vinci Energy Systems has announced today that the first cluster at the Energy Super Hub Oxford is now, they've basically handed over the keys. It's up and running and working, and all the batteries are working together. I mean, that is a fantastic piece of news, because it really does mean there is a live production facility out there that any other potential buyer of their product can go and look at and go, wow, that really works. And of course, just to remind people, at the Oxford Energy Super Hub, that whole battery system sits alongside lithium in a sort of hybrid form, which we think has a huge amount of potential future for putting the two together. And you could actually, even if you've got a big lithium battery storage project at the moment, there's nothing to stop you adding a bit of vanadium alongside it now to keep the life of your lithium going on a bit longer. And I think that's what a lot of these projects should do. Anyway, great reaction today. Nice to see the share price up above £1. Clearly what we want to see now is a flow of new orders coming through, so that actually we can see the stock back up to £2, £3, £4. And of course, then when they start selling with Siemens Gamesa, the stock could go even further. But let's not discuss that on this podcast too much. But would you agree with all of that, or have you got any other comments on that, Phil?
Well, no, look, just a reminder, it is a corporate client of ours, but it's leading edge battery tech, and it's a UK company. It's just great to see us. The UK is taking a lead in some of these projects, particularly the Energy Super Hub Oxford project, which is set to be sort of rolled out and replicated across the UK. So it's hybrid or it's pure lithium. But it's all for EV charging and for the EV markets ultimately. So it's an exciting, very exciting project, and as I say, this is sort of leading edge tech that's involved in it.
Yeah. Now, also just jumping back to my IPO bit, I probably should have mentioned That obviously we saw this week the announcement that PodPoint is going to IPO, and they are one of the biggest. I think they claim to be the largest in the UK of EV charging points. So that will be exciting for the EV charging points. I also see that Good Energy had a trading update, and just reading that out, the comment was the board is pleased to confirm that despite the ongoing volatility in the UK energy sector and low wind speeds in Q3 2021 impacting performance, there is no change to Good Energy's full year expectations. But it then goes on to say that in September 2021, it saw record-breaking growth in the UK electric vehicle market. 1 in 7 of all cars sold was a battery EV, representing a 50% increase basically from last year. So clearly, the whole UK EV market is going incredibly strongly. And also they own ZapMap, don't they? Which is the UK's leading EV mapping platform for where all these EV chargers are. And they said that was growing incredibly strongly too. So I think this was all coming out on Monday. Massive news on Monday for basically EV charging, and incredibly good news. And yet the play that we always talk about is Nexus Infrastructure, because they are actually also one of the UK's leading providers of EV charging points, although they often do it underneath somebody else's name. That stock didn't move at all, which is wrong. So yeah, we like Nexus. We say that most weeks, don't we?
We do indeed. Yes, it's a good story in the space. And another one that you might remember we put in our picks and shovels research piece was Volex. VLX is the ticker, 469 million market cap, and their shares are up 36% year to date. So it's been performing very well. So Volex make connectors and cabling systems, and these are not, they're not simple assemblies of cables that plug on the end. Far from it. They often have to carry very high electrical currents and current that's very stable and very controlled. So there's a lot of engineering goes into their products, and one of their markets, of course, is electrification, charging points, and in vehicles as well. So they made a couple of smaller acquisitions this week. One is for manufacturing in Mexico and the US, and the other is a large wire harness manufacturer in Canada. So there's been quite a few acquisition announcements this week, actually. That is one of them. So I just spotted that, and that again, EV charging linked.
Well worth, by the way, anybody who didn't see our picks and shovels note. It's up on our website. There's a portal, you can go in and read it. We picked some bloody good stocks there, actually. And actually also just as a small red herring, but purely because I know that one of the listeners to this podcast pointed out to me. I did a few weeks ago point out with all this gas crisis we're having that there was a gas storage company that was totally undervalued called Harland & Wolff. It's obviously Harland & Wolff is a shipbuilding company, but they did own this thing called Island McGee, which is a gas storage facility. I said, that's a tip, because with the gas crisis, you should be having a look at it. And it did jump 30% the other day as they got their license. So we give tips on everything on this podcast.
Yep, we try to cover all bases.
Yeah. Okay. What else do you want to talk about, Phil?
Yep. Okay. Well, there's quite a few things. Have you come across Discovery Group? Ticker is DSCV. It's a $1 billion market cap now, and it's been performing very well. I'm sure this used to be ACAL distribution originally, but it's electronics components, and design, manufacture, and supply of electronic systems. And the company's been quite acquisitive. It's grown by acquisition and organically. They've had results out. I think it's a trading update from them. But the first thing I'd point out about this company, Andrew, is and I'm obviously looking around the Hut Group and how they're getting information out to the market and describing what they do. And clearly probably a bit more work to do after the investor call this week. But look at this company, and if you look at the way that it reports and the financial information that it gives and the granularity that it gives, it's really, really quite impressive. It is, apart from the business itself and the business performance. But bearing in mind it's in electronics, bearing in mind all the issues with the global supply chains at the moment, and particularly highlighted for the semiconductor industry, they had, they'd seen their revenue pick up in there was September year end, but at the back end of last year's financial year, they'd seen revenue pick up, and they continue to see their revenue growth accelerate, and so and big increase in their order books as well. Now they're supplying, bear in mind that quite a broad range of industries: renewable energy, transport, medical, industrial, and connectivity, which is mainly communications, I think. But I was quite taken by this in that not only is it sort of recovering with the economic curve, but it's recovering through a supply chain stress that I can't remember when we've seen anything like it. And they're accommodating it. So that was quite eye-catching.
Actually, sorry, I'm jumping around a bit here, so I do apologise to listeners. But talking of performance, did you see, I think it was on Time Flies, Tuesday, that ESS, which is the Bill Gates-backed iron flow battery company, did its SPAC deal on NASDAQ and went up 150% on day one to a 3 billion market cap. I mean, okay, I know people like following Bill Gates, but seriously, iron flow batteries are really complicated because although they, in theory, are a really good idea, the problem is that the size of land you need to generate enough power compared with, say, a vanadium flow battery is literally 10, if not more, times larger. And so you just will never be able to get enough power out of them to actually function properly, in my view.
Right.
But $3 billion market cap. Whoa.
Yeah, well, and then back to our friends at Invinity and their flow battery technology are just over 100 billion market cap, or heading towards there. Look, I think, and having looked at tech for many years, is the race is on with battery technology for alternatives to lithium, or technologies that will be complement or be better than lithium. It can't be all lithium because there's going to be too much dependency on it, and again, stress on the supply chains. So these are very attractive things.
Anyway, we're repeating ourselves here now. So
yeah, exactly. Anyway, so moving swiftly onwards, there was a trading update from Electric Components, who ECM's a ticker. This one is a very large market cap, it's 5 billion. Why we're commenting on this? It's interim to September. Electric Components are one of the largest electronics distributors. So they're exposed to all sorts of end industries. So I always watch these companies like this, Andrew, because you can get a feel for the way that demand is occurring in the system. And they were saying, if you look at their full year to March 20, they grew revenue by 3.7% to £2 billion, which is kind of what you'd expect in a normal economic climate. And they've just said that their first half revenue growth was 30%, 31% revenue growth. And so that's quite exceptional. But again, to point out here, and about these supply chain issues that are, catching all the news, that they were able to achieve this recovery in a pretty chronic supply chain environment. So, firms are starting to absorb some of this. I mean, they have said that, when they look forward, they've got tougher comparators, obviously, because they've been through a strong recovery period, and that does include supply chain shortages impacting them. But it's quite intriguing to see how things are starting on things to be accommodated a bit.
I'll be honest with you, I missed that one, I think.
Oh, there we go. We're trading. Who else came out? There was an acquisition from Aptitude Software, APTD. The market cap, this is 369 million. And they have, and these shares have doubled over 5 years. So this is interesting. This is in accounting software and revenue recognition and lease accounting. Now, for those of us that might not be been counters, analysts, and accountants, revenue recognition, as we all know, will know from holding shares, and particularly technology shares, is a tricky old area. to say the least. And their software helps finance directors to do their revenue recognition, and also lease accounting is something very new as well that FDs are having to deal with. They have 80 enterprise clients, including Aviva, Bank of Ireland, and their revenue, their own revenue, is split pretty evenly between the US and Europe, which is a good sign. So this is a UK software company that's clearly got strong sales into the US. So they've made an acquisition. They announced this week for an enterprise value of £37 million to add to their software portfolio, and it gives them a presence in telecoms and media verticals. So that's that was quite interesting one. But this has been a nice steady grow. It looks at
that. I mean, look, working out revenue recognition is a very interesting subject. Going slightly off piste again, I was talking to clients earlier this week about how, looking at one set of reporting accounts is a bit like looking at a painting. Some people like it, some don't. It's a very judgmental. But what you really need to do is look at a film, which is actually look at a series of reporting accounts, because it's only when you have a series of reporting accounts, and actually what you should do is take the balance sheets and work out your own cash flow from the balance sheets in each set of accounts to really understand what is going on in those businesses. And it's really the only way. And so if you're valuing a company, you really want to use the film, not the painting. That was pretty off-piste.
It's pretty on point, because we're looking, particularly in tech space, things being valued on multiples of revenues, and without necessarily looking at it goes into the cash flows in terms of the discounted cash flows. And this is why interest rates will have an impact on tech valuations, because as you and I know, for the high growth companies, you're looking at forward cash flows that they throw off, and if they perform better, then where you can put your money somewhere safe. And if interest rates go up and the banks are paying better interest than your tech stocks generating in terms of its cash, then you go there. So no, you're quite on point there with that one. Always look at the cash flows of a business to get a proper feel for what's happening.
That's certainly what I do. Talking of cash flows, but a different sort of cash flow, I saw a very interesting chart, or whatever you want to call it, of cash flows into venture capital, tech venture capital funds, and where the money is actually really flowing in, because a lot of money in Q3 2021, it looks like about 150 billion euros of money went into VC tech funds. Huge amount of money, and it's grown recently, the amount of money going in. But what I found interesting about it was nearly all going into the segment of between 100 million euros and greater. There was a little bit of growth in the sort of 15 to 100 million euros, but actually in what is known as the C and the pre-seed round, virtually no growth at all of money going in. And yet, actually, I think at the moment that's one of the more interesting places to look at. Now, clearly, it's risky, and seed money is what, as it says, it's seed money. It can grow into something really big, or it can actually never grow at all. So you need to obviously look at a portfolio. And we've discussed this a lot on this podcast, so I won't go into the different sorts of portfolios, but I think it is interesting that, clearly money wants to go into this space, but it is going very much for the big companies rather than the small companies. But the small companies, I think, is where you're going to make your money.
It is actually, and seed investments this year has come down. As you're right, a lot of the money is going into what's called the mid-market space. But of course, with great irony, what that does is chase up valuations and make it harder to get returns. But I think probably the overall encouraging, clearly, I think there's a gap in the seed side as well. And of course, it's vital that investment comes in. Otherwise, where will the companies of the future, come from? So you've got to have that early stage of investment. But overall, what's been encouraging, I think, is the sea change in the last 5 years in terms of the scale of investment that's coming into the sector, and the more the better. And ultimately, as you and I discussed, the IPO market's vitally important to give investors, you and I, private investors, an opportunity to have a share in that growth. So it's not all, in private funds that we can't access.
Yep. Okay, we're going to get close to our time, and we want to keep this within 30 minutes. By the way, if you're driving and listening to this, do keep your eyes on the road. Any other results or anything you want to comment on, Phil?
I don't think there is, but your last comment there just reminds me of a joke I saw. It was a sign in a church, and it was along the lines that, if you drive, you've got your mobile phone and you'd like to see God, then keep viewing your texts.
Right, on that note, yeah, that was really bad. We'll call it a day there. But again, look, anybody listening, if you've got comments, just do feel free to send them to us. People do, and they're really useful. If you've got stocks you'd like us to have a look at, please tell us. We'll have a look at it. We'll try and look at the film rather than the painting. And on that note, we'll speak again next week.
Will do, Andrew. Look forward to it.